I've been trading for 7 years and helped thousands of people become profitable. If I had to start over today with everything I know now, this is the exact process I would follow step by step, along with 2 simple universal trading strategies you can start using today. Let's get into it. So what you will learn for today, first of all, the 3 rules of trading, and then we're going to go over the actual goal of trading. And believe it or not, most people are not just trading to make money. They're actually doing something else that is hidden. And then my top 5 trading concepts to study, because there are thousands of concepts that you can go over, and I want you to only master these 5. Now then you can be more flexible. And then the universal system, what is almost every trading strategy focus on? It's this universal thing. And then the 3 pillars of a trader. What are the 3 things that you have to have or you have to do in order to become profitable? The risk management, because it's one of the most important things. And then finally, the only 2 trading strategies you'll ever need. So I'll go over these 2 trading systems and then you can actually apply them today. Now this video will be focusing on the things that most beginners skip, the things that struggling traders ignore, and the rules that separate consistent traders from everyone else. So this video is going to be unique. It's going to go into things that most likely you did not think about, and you will not find on all of the other videos that are just repeated over and over, explaining candlesticks, looking at TradingView, how to enter longs and shorts. But that is actually does not matter as much as what I'll be going over on this video. Let's first talk about the 3 rules of trading. Now, this is what actually matters, and if you want to become a profitable trader, then you focus on these 3. With 1 missing, then probably you will not be profitable. The first one is thinking in probability, and this is something that we're going to be actually going over details on the next sections. And then the trading pyramid. When it comes to the trading pyramid, these are 5 levels that you need to fix from the base and then go into the top. You cannot start from the opposite. And any of these levels will affect your trading performance. So this is something that no one ever talked about. And then mastery over money. Talking about probability, which is something that we're going to go over details. But for now, every trade is a maybe. Think in this way. If I ask you a question now about a coin flip, are you 100% sure of a coin flip, of the outcome of it? Then the answer is probably no. That is the same for a trade. A trade is no different, and no setup is guaranteed, even if it has all the rules, even if it looks the best. And we'll cover this on detail in part 5. Now covering the trading pyramid, and I have a full video on this explaining everything, so I'll be having that on the description. But the issue here is that 95% of traders focus here on the strategy, and they think that this is all it matters. If they have the strategy, then they're gonna make money. But that is a very wrong way, and mostly everyone just talks about trading, focusing on the strategy, but forgetting everything that is below that is more significant than just the strategy itself. Now we need to start from here, going up, and we cannot fix the base from the top. We need to start from the base and then going higher, and going higher here is going to affect the strategy, and it's going to make it work if it works initially. But I mean, a strategy without the base is not going to make you money. So the first thing that we need to fix is the core beliefs about the money and markets. And then we focus on the beliefs about self and capability. But actually before that, core beliefs about money and markets. If you think that money is hard to make, if you think that there is limited money, if you think that the market is not going to give you money and it's all fake money, then you'll never make money. And then beliefs about self and capability. And this focuses on you thinking that you cannot make money. You thinking that you are not inconsistent. Thinking that you are not disciplined. And if you think yourself that you are not consistent enough in order to make money, then you'll never be. And then the emotional payoff. There is something that you actually getting. If you're not making money off trading, you're getting something else. This could be, getting love from others, getting support from others, that you are working and you're trying to become a profitable trader. So payoff is the thing that you're getting that keep you stuck. And then the behavior and habits, and that's where a lot of people actually focus on, is, trying to be disciplined, trying to be consistent, but you cannot. This is only the symptom here. You cannot fix this without fixing what's below. And the strategy, and this is what actually 95% traders try to fix and focus here. In reality, they have a good strategy, but everything below is broken. So you need to start from the bottom and fix all the way to the top. And I would say a lot of people actually have an edge when it comes to a strategy, when it comes to trading, when it comes to finding setups. But the problem is that there is an execution gap. They cannot execute it perfectly because of everything below. Now, before we continue, just a quick thing. Everything I've learned over the last 7 years, the frameworks, the system, the way I read the market, it's all inside my community, Edge School. That includes the Edge model, the same strategy I use to find those 5-to-1, 10-to-1, sometime even 20-to-1 reward to risk trades. And I take those trades live with the community. If you want to learn the full system that I use and trade like me, there is a link in the description with all the details. If you're not ready yet, no worries. Let's continue today's lesson. Now let's talk about mastery over money. Now the skill comes first and the money later. Think about athletes, for example. They train and they do a hard work before focusing on the trophies. They cannot focus and just think about trophies, become athletes in order to get that. No, they need to work hard, and being good at what they do, that's the main focus, and then the money is gonna come after. Think also about doctors doing the same. Study before income. Engineers build the skill before getting the salary. So trading is no different, and that's the problem a lot of people have, is that they're thinking trading is different. Trading is the same as every job. You need to master the thing that you're doing in order to get the money. The money comes after. And a lot of people fail because they miss one of these three. If you miss one, then you're probably not gonna make money. Now let's talk about the actual goal of trading. What are we trying to do here? Now, keeping it very simple, we have long and we have short. Now, the main goal is to simply buy low and then sell high. Buy low and sell high. Now, you don't need to be buying at the extreme bottom. You can buy here and then sell here. And if you're shorting, that means you're selling here and then you're closing your position lower. So doing the opposite. So all it's needed is that I buy somewhere and then I close my position higher, or I sell somewhere and I close my position lower. The problem is that a lot of people complicate this. This is common sense, but the problem is a lot of people actually try to impress others, feel smart, get respect, and this is the payoff. This is the emotional payoff. They try to impress others, posting screenshots. They try to feel smart by predicting some time and not execution, and that is a problem. Let's make the main goal is that we actually execute buying lower and then selling higher, and that's all. That is the actual goal of trading. Let's now go over the top 5 concepts to study in my opinion. You focus on these for now, and then you can after expand to other concepts, but these are very enough to you in order to have a good start in trading, even if you are resetting. Now again, I do have a full video explaining these 5 concepts in details for over 40 minutes, and I'll have that on the description. Make sure to watch that. I'll just go over them very quickly here. So the 5 concepts are, the first one is a fair value gap or an imbalance, and I'm not using all the ICT concepts, but I focus on the ones that align with my trading plan and the ones that I think they work for me after 7 years of trading. Now, fair value gap or an imbalance is space in between the first candle and the third candle between the wicks when they're not overlapping. So between candle 1, the high of it, and candle 3, the low of it, this is the imbalance. And a lot of time I focus on 50% of it. So if price comes back to this level here, the 50% of an imbalance, I'll be looking to buy. And in a bearish scenario, I'll be looking to sell. Now this could be used as a direction, as an entry, as a confirmation, a different way to use it. Now the second concept is liquidity, and liquidity is money. It's basically everywhere on the chart. But you know, to simplify this, you focus on highs and lows, and you focus on kind of some support and resistance levels, and you're waiting for either for price to go above it. There are actually 2 scenarios here. We have a high, either price goes above it and displays and then close above it, and a lot of time we're gonna have a continuation because this is where a lot of money was, and if we're disrespecting that one, then we're having continuation. If we actually go above it and we fail and we have some weakness here, then probably we're gonna have a reverse. So 2 scenarios at liquidity. And again, it's the same as an imbalance. It can be used in a lot of different ways. Now 3 is SNR, and here we focus on opening price, and this is what I actually teach on my Edge School, and this is what the Edge model is based on. Now we focus on where the, so you see here we have an opening price, price goes lower. And a lot of time, if price comes here, I'd be looking for selling. And here we have a change in the candles colors. We have bearish candle, bullish candle. I would consider this as a support area. And support and resistance could be seen in a lot of different ways as well. But this is my personal way here, is focusing on the opening prices, simply the bodies to the wicks. And then market structure. And this is an essential. This is something that I cannot trade without. Now, think about market structure is, telling you what the market is doing. If we are breaking structure to the downside, then what I'm expecting, we have a breakout structure here, we have strength. So now I'm looking for a continuation, most likely to the downside from here. If I'm breaking lower, same thing here, breakout structure. What I'm looking for is now price to go up, but then going lower. Now for this one here, because we started going lower, and here we have a breakout structure to the upside. What do we expect now is price to go lower and then go higher, all based on market structure. And I did explain this in a lot of details on the video on the description. And finally, time frame alignment. And this is an essential thing. This is, if you told me about the most important concept, it's going to be this one, time frame alignment. It's all about aligning the higher time frame with the lower time frame. And for example, we have a key level here. It could be an imbalance, could be a liquidity, it could be an SNR, it could be anything. We have this on the higher time frame. We go to a lower time frame. So for example, we go from 4-hour time frame to 15-minute time frame. And then when price gets there, I switch to the 15-minute time frame now, and I look for a confirmation. Simply, I'm waiting for the alignment between the higher time frame and the lower time frame, and then I'll execute after. Now, these are 5 concepts. These 2 are an essential, and then from these 3, you can actually use 3 of them, 2 of them, or just 1 of them. So you could use SNR by itself, and market structure and time frame alignment, or liquidity, and then again these 2 essential ones. So 2 plus 1 of these, or 3 of them, depending on your understanding and how you can apply them together. Now let's talk about the universal trading system. Everyone explains the strategy differently. So if we look at ICT, if we look at supply and demand, these are way too different. Support and resistance, market structure, price action. If you go and try to find a video for each one, you will see them explaining them very differently with different namings, different steps, and everything is different. And it's all about complicating stuff. But almost all strategy are the same, and they are based on key level to another key level. And no matter what the key level is, so it does not matter, because all they focus on is what? Price going to a key level. That first key level could be a support level, going into, for example, a liquidity level, or it could be going from, I would say, an imbalance to a liquidity level. So it's always from a key level to another key level. And it's the root of every strategy you've seen on YouTube. It's all based on this. You make this your trading plan, you identify the key level, you trade the price from that key level to the next one, and these could be different, these could be the same, so it could be from an imbalance to another imbalance, from a liquidity to liquidity, or from a support level to an imbalance, from a support level to liquidity, or just based on market structure, a level on the market structure to another, and nothing more is needed. This is one of the most important things that I want people to be aware of, is that trading is all about a key level to another. Every strategy you see is all about a key level to another, and that's it. And this is how we see it. Key level to another key level. We have a key level here. What happened is I'm looking for this key level to another one, a logical one. So if I'm expecting another breakout structure to the downside, I'll look for another key level. It could be here. Price reach that key level, right? Price goes up. I have a key level here. I'm looking for price to trade from this key level to this one here. So I take longs here and I hold to the next key level. A key level here from this one, or even from this one here to this one now. From this one here to this one here. And it's all like this. So if I have, for example, an imbalance here, I'm trading this imbalance to a low here, for example. Or if I'm trading, if I have something like this, I have some resistance here and a support, I'm trading from here to here, from here maybe to somewhere in here, if I have a new level being created. And that's it. Now stick with me until the end, where I'll be going and teaching you the core framework I've refined and used for 7 years now. So this is something that I came up with a long time ago. I've mentored a lot of people to use it, and now I'm going to teach it to you for free here. I actually teach you two different strategies, one that is universal and one that is very specific. So stay until the end. Now, the three pillars of a trader, you should do these three things in order to make it in trading. And these are different than the three rules of the game of trading. These are three things for you to do as a trader. The first one is risk management. Now, for risk management, the main purpose and the main goal is to survive the market. So a lot of people who actually quit trading very early, it's because of risk management. So survival is because of risk management, and it is capital preservation. So without risk management, you'll be most likely quitting very early. And I think you are being here because you had a risk management. So otherwise, you'd be most likely quitting trading because you lost most of your money. And the only formula that actually matters when it comes to risk management, and it's not the reward to risk ratio, which actually a lot of people focus on, which matters, but it's not as important as the formula that we're going to go over. And why? Because you could have a very high reward to risk, but still lose. You could have even 5-1, 10-1 reward to risk. That is your focus, but you're still losing. Same as win rate. You could have a 90% win rate, but still losing. And then a lot of other formulas that people talked about, but the one that matters the most is the one that we're going to go over now. Now, the formula is the expectancy. Now, if we focus on what's in between here, it has both the win rate and the average reward to risk. So it's not only about the reward to risk, and it's not only about the win rate. Each of these can be high, but you're still losing. But when you combine both of them, then you can find the real edge. So what is expectancy here? Is the average amount of money you can expect to make or lose every time you place a trade. But here, we're assuming that you stick to your system. You have risk management. You are actually sticking to one thing. That's how we build, or we calculate the expectancy. Now, positive versus negative expectancy. A positive means you have an edge. It means that the math is in your favor and you're expected to be profitable over time. So you need to calculate if you have some data for, let's say, 6 months, 3 months, or maybe more, then you can calculate your expectancy. And if you have a positive one, then you are expected to be profitable over time. If you have a negative expectancy, it means that you have no edge. The math works against you and you are guaranteed to lose money in the long run. Now, no matter what you do, you could make money today, tomorrow, but in the long run, you'll be losing. Now, how do we apply expectancy? If you risk $50 on one trade and $300 on another, you feel confident and you'll be sizing up randomly, the math will break and your edge will disappear. We cannot apply expectancy here. We cannot calculate the real expectancy here because you're not sticking to one risk percentage. So the rule is we need to risk 0.5 to 2%. I mean, you could be flexible on this. And this is the max of your account per trade. Now we decide the risk first. So let's say I'm risking 1%. And then we focus on the position size. So regarding the position size, let's say we have an account that is $10,000. And these are the things that we need to identify first. The account size, the risk per trade, for example, 1%, which is $100. Stop loss is where the trade is invalid. The position size is calculated so that if I hit my stop loss, then I lose exactly $100. I cannot be using different position sizes. Now, how do we actually do this? You could use this link here, or you could use the indicators that I have on TradingView. I mean, I'll have a link on the description for that one. Now you have the currency, the account size, the risk percentage, and the stop loss in pips, and then the pair, and it's going to tell you what is your position size. So standard lots here, 0.5, that is the size that you enter with. Now let's talk about the trader mindset. There are actually a lot of different ways to see the market, but the best one in my opinion is seeing it in probability and not certainty. And this is actually inspired by one of my favorite trading books. One of my best books that I've ever read is Trading the Zone. Now this means that trading is a probability and not certainty. That means no setup is ever guaranteed. No matter how good it looks, every trade is a maybe and not a sure thing, and professional things in odds and not predictions. One trade means nothing. A single trade is random like one coin flip. And I've already asked you that question. Are you actually sure 100% of the outcome of a coin flip? The answer is no. And as the same applies to a trade. And results only matter over many trades, and you must let the math play out. Wins and losses are randomly distributed. Even great strategies lose multiple times in a row, and you cannot actually know when a winner is coming and when a loser is coming. You know that, okay, I do have a 50% win rate, but I don't know when the winner is going to be and when the loser is going to be. And losing streaks are normal, and they don't mean that your strategy is bad or broken. Think like the casino. They do not win every hand. They rely on a small edge plus repetition. That means if you want your edge to play out, then your job is to execute and keep executing without changing the plan and without focusing on the money and without guessing the outcomes. And finally, detaching from individual results. That means a winning trade does not make you good, because if you are not sticking to your plan and then you were lucky and you've taken just a random setup, you make money. That does not mean that that trade was good. And a losing trade does not make you bad. If you're sticking to the rules and you've actually executed your plan, it could be a loser and it does not make you bad. A trade that followed your rules is a good trade. Either it's a win or lose. That's how a profitable trader mindset looks like. This is what they think about. Now let's talk about the only trading system that you need. So we'll be talking about two setups here. The one rectangle, and that is the one that we're going to be focusing on today. And then the WTS framework, the weakness to strength. Now the one rectangle is going to be a complete strategy based on one rectangle. But the WTS is going to be a universal trading system for any key level. So no matter what key level you use, no matter what kind of, your specialty is, either it's an imbalance and support resistance, supply and demand, whatever you're using, you could be using the W2S framework, because the goal is to give you a high probability range, and this is what this does. Talk about the first setup, which is the one rectangle, and I'll be using some references from the book that I wrote. If you want to have access to it, then it's going to be in the description. But we're going to be talking first about the strength and weakness, which is going to be the trigger. Now, strength in simple terms, you can take actually a screenshot of this, or you can have access to the book. Now, strength is displacing and closing in a body, closing way below the low. Now, when it comes to weakness, it's failing to close, simply having a wick, having a rejection of the low. Now, the moment we actually can identify these, and the focus is going to be on the weakness. We want to see this, and then what we're going to be doing is identifying the rectangle, because we said we want to trade all based on one rectangle. Now you need to see this weakness in a good market structure that is high probability, into a key level, all of these things. But then we identify the rectangle. Now how do we do that? If you notice, this is where the weakness is. We close like this, we wait for this 15-minute candle. I forgot to mention that we're going to be using 15-minute and 1-minute time frame. So everything that we discuss here is going to be on the 15-minute time frame, and it works for any pair. We want to see weakness. We confirm this by waiting for this candle to close, and then after the closure, we draw the rectangle. We draw the rectangle from the low to the body, and then we switch to the 1-minute time frame. So let's do this here. Actually, I'm seeing a very nice example here. If you notice, I see that we have actually weakness here. We only close one candle above and then going lower. So I'm only looking at market structure here. So we have structure, we have a breakout structure, and notice what happened after. Actually, I can see that we have weakness here. We can execute based on this, especially that we are in a good structure going lower. But after this breakout structure here, what we also have is this weakness, another weakness. Now the candle needs to be, in a bearish scenario, if I'm looking for short, the candle needs to be bullish. Now this one is a bit different because it is bearish here, but this one is bullish. So let's actually focus on this one here, because this one is valid. We never close above it. We have a rejection. I'm going to take a rectangle from the body to the high, and I'm using the replay here. So you notice we have this. I'm going to now switch to the 1-minute time frame, and the trigger, the entry is going to be closure below the rectangle. If we close 1-minute candle below it, then that is the trigger. So let's play the price action. If you notice, this one closes below. I'm going to enter based on this and then have a stop loss above the high. And that's it. Now playing the price action, if you notice, we have a retest, and notice how price is actually respecting the entry, respecting the rectangle as well. Exactly there. That is the precision that we're talking about. You see here as well as here. And this is a method that I've actually developed after 7 years of trading. Now we play the price action. Okay, price goes a bit above, and then getting all this profit, you could switch to a 15-minute time frame here, and notice what happened. Now you could close your position after seeing weakness, another weakness. If we look at how much we're getting out of this, we got around 2.74, which is around 3 to 1, and then a bit more. Now it gets very close to the take profit after 3 to 1, but then continues for 8 to 1. Now if we go back here, I can see a lot of other examples. I'll just go over one more, and then you have access to the ebook. We can learn more about it. Even I have some videos about this specific strategy, and then we go to the other framework. Now if you notice here, what happened? We have price overextended into a key level here. That is one of the key levels that we use in Edge School. Okay, now you can also cover this here, but I'm refining this. Okay, now we notice that price goes here, try to go again, but here we have weakness because we're never able to close above it. Now what do? Whenever we spot the weakness, we actually take the rectangle from the body to the wick, drag it to the right, switch to the 1 minute time frame, and then all I want to see is a closure now below the rectangle. Let's see. So it goes up. Okay, and this candle here closes below. Now you could enter immediately from here. Stop loss goes above the high. Sometime I would love to see a retracement, so I could have another order here also, and then stop loss above the high again. So something like this. And then what do we target? You can actually go to 15-minute time frame here in order to look for another low to target or another key level. Now what do we have here? I can think of this, for example, and then the other entry, for example, here, or at the low here. And then let's go back to the 1 minute time frame, see what happened. Playing the price action, very nice, going lower. Okay, a bit of a retracement here. Let's see the 15-minute, what do we have? Then price is just going lower and lower and lower. If we look at the 1 minute time frame now, what do we have here? Look at this, insane trade, over 10 to 1. And this is what I actually teach in Edge School, but I teach it in even a much better way. So you see 9 to 1, and price did not, give this order, so we remove this. That is a very nice trade. Now into the second setup, which is the W to S pattern. Now for this one, because now we do understand the concept of weakness and the concept of strength. When it comes to weakness, it is failing to continue on the same direction. So having weakness, for example, price is going lower, and then because now it's going lower, but now it fails to go lower at this point. Now strength, on the other hand, is continuing in that direction. So here we have strength, and here we have strength. So strength is continuing on that direction. Weakness is failing to continue. Now we did focus on specific types of weakness and strength on the one rectangle method, but for this one, it's not going to be just a single candle. It's going to be, seeing the candlesticks around the key level. So are we actually displacing below the low or displacing above the high? Why is this pattern, first of all, universal and important? Price is going up. The moment we can spot a weakness, it's telling me that now we are about to, we're finding weakness here. We can now go higher, and that means there is a potential of reversal now, but it's not confirmed. When does it get confirmed? Whenever we have strength on the other direction. So the moment we have this, and then a strength on the other direction, which is something like this, then we can say that, okay, we do have the weakness, and then after that we have the strength, and that is the W to S pattern. And this here gives me the core concept of almost every trading strategy, which is trying to focus on a high probability trading range. Now what is a high probability trading range? It means that from this high, which caused, or which was created after the weakness, and then the low here, which was created after the strength, I can say that, okay, this is actually a high probability range. And high probability range means continuation. So this is a high probability range, and it is a bearish one because the strength was to the lower side, and that means it's a high probability range, meaning that we'll have a continuation to the downside from this range. This range will be respected. So I could do something like this, go short here, stop loss above, and then look for continuation to the downside. This is what a high probability range is. Now, whenever we have this pattern, what we do is we could, in another strategy, what I said is we want to spot this pattern, which is weakness, strength, and then weakness. That means, what do we have here? Weakness, strength, which is here. And then I want to find weakness inside of this in order to trade it. So the moment I spot a weakness, I can trade that one. But in a universal way, is that inside of this range of the WTS, what I want to do is look for a key level inside of it. So you could, for example, focus on an imbalance here, supply and demand area, or a candlestick pattern, anything you want here. Okay, anything. You are free to use whatever you want. But this here is going to establish this high probability range. So let's say I'm looking for an imbalance here. After this range, what I will do is I'll wait for reaction of this imbalance and then trade lower. Or I could simply have a limit order at the imbalance, stop loss goes above the range, and then take profit at another strength. Let's spot a range that has two things. Now we could have, there are a lot of ranges here, but I could see that there is one here. What do we have? We have a weakness, and then after that, we do have strength. This is a low after taking this high, and then we broke below it. So now you want to look for a key level inside of here in order to trade from it. Now, sometimes it's not going to be very clear for you. Now, we do have this key level here, but I mean, there was no imbalance to look at here. But let's look at another example. For example, we do have this key level. Okay, so I could mark this key level here. Again, you could be free to use any key level you want. And let's look at what happened before this. What we have is weakness and then strength. So weakness and strength give me a high probability range to trade from. And that means high probability range, retracement, and continuation of that high probability range. And that's what happened here. So we mark a key level, reaction, and we could trade, we could look at 50-minute confirmation here. What is another example? Right here, we have weakness, but then we did not follow by a strength until right here. And then what do we have after? So now what we have is a high probability range. This is the low of the range, and then the higher the range is here until we have the retracement. Now you could say here, but then we only confirm the high after the retracement. And notice what happened. We have this imbalance, price gets to that imbalance and then start going higher. Now, sometime the weakness could be just price getting into a key level. So I could consider this as weakness because it filled a key level. And then after that, what do we have? Strength. So now I could trade the continuation again. And it depends on the key level that you're focusing on. And same thing here. Weakness, because it went into a key level, but it also only closed one candle below and then immediately goes higher. A breakout structure. What can we do after? Is looking at a key level that actually holds the price higher, and then price goes higher. And we could see this in a lot of different forms, right? So I could see this here as weakness and then strength. And then after that, after the whole move here, we have a retracement to this key level exactly here after this range. So we want to focus on that WTS pattern and then we trade from. Let's look at an example that I go from a higher time frame to a lower time frame, and we cover all of the steps. There is weakness and then there is the strength. And now this range here, actually I'm just gonna go until this range. Now what do we have? We have the low and then we have the high, and then what you can do is take a fib from the low to the high, and you want to focus on this area. So this is another way, this is another use of using key levels, right? You could use anything you want here. Continue going higher until we have the retracement. So for now, what I'm going to do is I'm going to take it to the highest high, and now we have the OTE here. What kind of key level I want to use here? What I would say here is that, okay, I do have this key level from, some of the key levels that I teach in Edge School. These ones here, these are strong levels. The opening prices, but it comes in a unique way. But also what I have is this imbalance, and this imbalance, the 50% of it is right here. So I'm going to take this one and notice how price was coming to this level as well as the imbalance. Now what I'll do is go to the 15-minute. What I'm expecting from this range, and this is the strength of this, is that this is a high probability range, right? Whatever comes after is a retracement. And then what I'm expecting after of a key level is another breakout structure. So something like this, and maybe sometime as big as this, or maybe half of it. So what I'm expecting is something like this. Not exactly the same way, but I'm expecting a bigger move and mostly break in structure. Maybe if this is also another high probability range, it's gonna respect part of it and then continue lower. It depends on the higher time frame high probability range. All right, so let's see now if price respect the 50% imbalance. Okay, 50% of the imbalance, it actually respect that one and then immediately go higher. Now after this, now we do have another high probability range here, also on the lower time frame. So you could have entered here based on this engulfing candle, but also because we have weakness and strength, you could have a limit order somewhere. So I could have here the 50% of this candle only if price retraces to that one. Now I don't know, somehow price gets exactly right there, so not sure where the 50%, but exactly right there, and then starts. So now what is the same thing? This is a retracement. I'm looking for another expansion because this is a high probability range. Let's see. I'm gonna switch now to the 4 hours. So price gets in there very close to the stop loss as well. So I just put a random stop loss. It depends. So just a random stop loss. You could be out. We go 4 hour. Yeah, I'm being honest here. But you could have also another entry. If price takes you out, you could have another entry after this high probability range. You could have another entry. Okay. And then exactly right there. So we have another sniper. Now this one I put a random stop loss here. You could have it a bit below and be safe. But you know, we could consider this as a stop loss. And I'll play the 4 hour time frame. Let's see what happened after. Because now what do we have? We have a high probability range here. And I'm expecting another one, something like this. Let's see what happened. And then price immediately go there. So that's a 6 to 1. Now this one was, yeah, actually this one is the new one. Okay, it gives about 4.69 and then it starts going lower. Sometime you could have a better entry. So based on this as well, we have what imbalance to imbalances. We could have an entry based on the imbalances. So from this imbalance to the second one. Okay, yeah, it's around the same area here. Price gets there and immediately goes higher. And you could have, if you wanted, another refinement. Now you could be flexible with this. You could have a lot of different entries, but what you can also do is after price giving you another range here, you could trade based on this and then trust this range. So instead of a stop loss that goes below this range, what you can do is after the confirmation here, you could have it below the low here. And that's going to give you much higher reward to risk, about 11 to 1. So almost more than the double here. So sometime I will do this if I'm sure about the key level that price was reaching. And other times I would do the opposite, you know, I will cover the whole range just like this. So it all depends on your approach. But the main approach that we're following here is what? The W to S. The moment we have a weakness and strength, just like this, weakness and strength, I would be trading the continuation. The moment I have weakness and so yeah, this time here we did not have a strength, but we have this internal strength and then a continuation. And it goes like this. You want to be taking these in a good price position and it's going to go from there. That's the end of the video. If you have any question, you can leave them in the comments. Hit the like button and share the video with your friends. Subscribe to the channel. That's it, and I'll see you in the next one.